Section 7, page 2 of the loan estimate. Where did all these fees come from? Okay, Sarah, who are all these people we're paying? Carlos understood page 1 of the loan estimate reasonably well. He saw the loan amount, interest rate information, projected payment, estimated closing costs, and estimated cash to close. Then he turned to page 2. His confidence disappeared. Carlos calls Sarah and says, I have origination charges, an appraisal, title-related costs, recording fees, prepaid insurance, property taxes, and an escrow account. I thought I was just getting a mortgage. Who are all these people we're paying? If you've represented buyers, you've probably heard some version of that question. Page 2 is where the transaction starts looking expensive because many of the costs connected with obtaining the loan and completing the transaction appear together. Let's slow it down and make sense of it. Start with loan costs. Page 2 separates costs into different categories, and one of the first areas Emily and Carlos encounter is loan costs. Under Regulation Z, this section includes categories such as origination charges, services the borrower did not shop for, and services the borrower did shop for. Origination charges generally involve costs associated with the creditor's or loan originator's role in originating the mortgage. Depending on the particular transaction, consumers may see items such as points or other lender-related charges. Carlos points at one of the charges and asks Sarah, is this lender charging too much? Sarah needs to recognize the boundary we've been building throughout this course. She can identify where the charge appears and encourage Carlos to ask Jason to explain it, but Sarah shouldn't decide whether a mortgage origination charge is appropriate or whether Carlos should accept the particular loan product. Remember, recognize, communicate, document, refer. Services you cannot shop for. The next category includes certain services the consumer cannot shop for. Imagine Jason tells Emily and Carlos that the lender requires an appraisal and selects the appraisal provider through the lender's process. Emily cannot simply say, my cousin does appraisals, I'll use him instead. The lender has requirements connected with the mortgage transaction, and some required services do not permit the consumer to select the provider. These charges matter under TRID because, as we learned in Chapter 1, the consumer's ability or inability to shop for a service can affect how certain tolerance rules apply. This is why simply looking at a fee and saying, that can increase 10% can be dangerous. You need to understand the category and the facts. Services you can shop for. Now we reach a category that frequently creates questions in real estate transactions. Services the consumer can shop for. When the consumer is permitted to shop for certain settlement services, Regulation Z contains requirements concerning a written list of available providers. This gives the consumer an opportunity to consider providers rather than automatically being forced into one selection. Let's look at an example. Emily says, Jason gave us a list of companies, but my parents used another provider and really liked them. Can we use that company? That's a question Emily should raise with the lender and appropriate settlement professionals because the answer can affect the transaction and potentially the treatment of the estimated charge. Sarah shouldn't casually say, sure, use anybody you want. There may be lender requirements, contract considerations, timing issues, or cost consequences that need to be understood first. Where the agent needs to be careful. This is especially important when an agent recommends a provider. Suppose Sarah says, don't use those companies, use this company because our brokerage works with them. Now we may have additional issues to consider. Is there an affiliated business relationship? Is a disclosure required? Is the consumer being told they must use the provider when they actually have a choice? Are there RESPA concerns involving referrals or compensation? Those questions can become significant very quickly. A professional agent can provide appropriate information and resources while being careful not to misrepresent the consumer's choices or create the impression that a particular settlement service provider must be used when that is not actually the case. Then come the other costs. Page 2 doesn't stop with loan costs. Emily and Carlos also encounter other costs. This is where they may see items involving taxes and government fees, prepaids, initial escrow payments at closing, and other transaction costs. Carlos sees prepaid homeowner's insurance and says, why am I paying insurance before I even own the house? Because certain costs may need to be paid in advance as part of establishing the mortgage and preparing for closing. Depending on the transaction, prepaid items can include homeowners insurance premiums, mortgage interest, and property taxes. Then Carlos sees money being collected for an escrow account. Wait, I thought we were already in escrow. Great question, and an excellent example of how terminology can confuse buyers. Two different uses of the word escrow. In Arizona real estate, Sarah may talk about opening escrow after the purchase contract is accepted. That's the settlement process involving the escrow company handling the transaction. But on the loan estimate, an escrow account may refer to funds associated with a mortgage that are collected and held for expenses such as property taxes and homeowners insurance. Same word, different concept. An experienced agent should recognize why Carlos is confused. Sarah can explain the general distinction, while Jason should explain the specific mortgage escrow requirements and calculations associated with Carlos's loan, Arizona recording fees, and government charges. Emily also notices charges connected with recording. In an Arizona transaction, documents may need to be recorded with the appropriate county recorder. Those government-related costs can appear as part of the transaction's disclosed costs. Again, Sarah doesn't need to memorize every recording fee in every Arizona county. She needs to understand why the category exists and recognize when something appears inconsistent enough to require clarification. The goal isn't to turn Sarah into an escrow officer. The goal is to prevent Sarah from saying, "I have no idea what any of that means," when her buyer asks about a document central to the transaction. Remember the tolerance rules. This is where Chapter 1 comes back into the conversation. Some charges generally fall into the zero tolerance category. Certain charges may be subject to the 10% cumulative tolerance. Other charges may change without those particular limitations when regulatory requirements are satisfied. Page 2 helps Emily and Carlos see the individual charges that eventually feed into those calculations. But Sarah should not look at one changed fee and immediately announce a TRID violation. Who selected the provider? Was the consumer permitted to shop? Was the provider on the creditor's written list? Did circumstances change? Facts matter. Broker tip: don't let buyers discover fees at signing. One of the easiest ways to create an unhappy buyer is to let them ignore financing documents until the end of the transaction. Imagine Emily sitting down to sign and suddenly saying, "What is this $1,200 charge?" That's not the ideal time to start investigating. When the loan estimate arrives, encourage the buyer to review it. If something is unexpected, get the appropriate professional involved early. Questions are manageable. Closing day surprises are harder. Emily and Carlos now understand where many of their transaction costs are coming from. But Carlos notices something else on page 2. All of these charges eventually produce totals, and those totals have to connect back to the amount of money they're bringing to closing. Carlos looks at Sarah and asks, "So how did they actually calculate the amount we need to bring?" That's where we're going next. Online discussion 1. Carlos sees an appraisal charge under a category for services he cannot shop for and asks Sarah whether he can choose his own appraiser. How should Sarah respond? Answer: Sarah should avoid promising that Carlos may select his own appraiser. The creditor may require the appraisal and control the appraisal ordering process. Sarah can explain generally that some services required in connection with the mortgage are not services the consumer is permitted to shop for, and should direct Carlos to Jason for an explanation of the lender's appraisal requirements. Emily wants to select a settlement service provider that is not on the lender's written provider list. Why should she speak with the lender before making that decision? Answer: the consumer selection of a provider can affect the mortgage process, timing, and potentially how the associated charge is treated under the TRID tolerance rules. Emily should understand whether she is permitted to select the provider and what effect that choice may have. Sarah can assist with transaction coordination, but should have the lender explain the lending consequences. 3. Why can the word escrow be confusing to an Arizona buyer reviewing a loan estimate? Answer: Arizona real estate professionals commonly use escrow to describe the settlement process handled by an escrow company after a contract is accepted. Mortgage documents may also refer to an escrow account used to collect and hold funds for expenses such as property taxes and homeowners insurance. An agent can help the buyer understand that these are different concepts while directing questions about the mortgage escrow account and its calculations to the lender.